a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about DFA's mutual fund conversion into ETFs and 3 ETFs, very cheap ETFs that you must own in your core portfolios. So last week, Dimensional Fund Advisors, or DFA as they are known, they are very well known in the mutual fund for their smart beta or factor strategies. They converted about $30 billion worth of their ETFs their mutual funds into ETFs. And with that conversion, DFA became the 11th largest ETF provider. And earlier, DFA was very selective about selling their products. They sold their products through certain advisors only. And now in the ETF wrapper, all their strategies are available to retail investors and at a very low cost. So according to Bloomberg, this is the start of a trend, and over the coming decade, more than $1 trillion worth of mutual fund assets could be converted into ETFs. And according to Citigroup, in the next decade or so, the $21 trillion mutual fund industry would consist mostly of ETF. Now, investors love ETFs over mutual funds because they are more cost efficient and they are generally more tax efficient compared to mutual funds, and they are more transparent to compared to mutual funds. So that is why over the past decade, we have seen this outflow out of mutual funds and a lot of inflows into ETFs. And this year, the ETF industry has already gathered more than $450 billion in assets, which is significantly ahead of the total inflows last year. Now, let's take a look at 3 ETFs that I would recommend. They are a must own for all long-term focused investors in their core portfolios. So the first one I'm highlighting is the Vanguard S&P 500 ETF, ticker symbol VOO. Now it is the cheapest S&P 500 ETF with an expense ratio of just 3 basis points. That is $3 for every $10,000 invested. And because it is the cheapest S&P 500 ETF, we have seen that it has been gathering assets from SPY, which is the most popular S&P 500 ETF, and that charges 9 basis points. So if you're a trader, maybe still use SPY because it is more liquid, but for long-term focused ETF investors, VOO and IVV are the best products. Very popular with $228 billion in assets. Now to learn more about this ETF, you can go to the quote page on Zacks.com, read our research report, articles, and go to the Vanguard web page for this ETF and see what it holds. So as expected, it has a lot of focus to large cap US stocks because it is a market cap weighted ETF, and rather lower exposure to medium cap and small cap. Nothing in the small cap space. About 500 stocks and well-known companies: Apple, Microsoft, Amazon, Facebook, and Alphabet are the top holdings, and then some financials like Berkshire and JP Morgan Chase. Now, the second one, which I'm highlighting, is again by Vanguard. It is the Vanguard Total Stock Market ETF. So if you want exposure to small cap and micro cap stocks too in one ETF and one product, then this is a product for you because VOO doesn't hold small cap and micro cap stocks. So if you have a little bit more risk tolerance, look at VTI. This provides exposure to the entire investable US equity market. As I said, large, mid, small, and micro cap stocks, everything is included. This also charges just 3 basis points and very popular with almost $250 billion in assets. Now again, to learn more about this ETF, we can go to the quote page on Zacks zacks.com, and from there the external home page, and look at what it holds. So it provides exposure to CRISPR US total market index, and if you look at the exposure portfolio, you will see that in addition to large cap and medium cap, which is lower than SVOO, it holds a medium to small and small cap companies too. Now, if you look at the top holdings, similar but lower exposure to these mega cap stocks, because it has some exposure to smaller cap stocks too, but thousands of stocks in one portfolio, one ETF. Now, the third one which I'm highlighting is by Invesco. Invesco NASDAQ 100 ETF, ticker symbol QQQM. This is basically the cheaper version of ultra popular ETF QQQ. So whereas QQQ charges 20 basis points, this charges thus just 15 basis points, and it provides exposure to 100 stocks which are listed on the NASDAQ excluding financials. And this also has over $1 billion in assets, though this launched just in October last year. QQQ has been around for a long time, but QQQM, which is a cheaper version, launched just in October last year, but people have been switching. So again, if you're a trader, maybe use QQQ because of its excellent liquidity. But if you are an investor, a long-term focused investors, you should use QQQM. And if you're using this product, probably you have a little bit higher risk tolerance than other retail investors, because it has a lot of exposure to those growth stocks. So again, to learn more about this ETF, you can go to the quote page, and I had done a podcast with Invesco on this product. You can go to the external home page, and as I mentioned, NASDAQ 100 stocks excluding financials, and you can look at the portfolio. So again, as I mentioned, this is more suitable for long-term investors which have a slightly higher risk tolerance because a lot of exposure to technology. Now, we have heard about this rotation into value out of technology and the tech wreck and all that, but tech wreck has really not happened. Technology stocks are also doing very well this year, though they are taking a breather compared to their performance last year. But these companies, Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Google, Nvidia, all these companies which are the top holdings in the portfolio, these are very high quality companies. They are profit making machines, and they will continue to do well in the coming years and the coming decades. So some exposure to them is a must in any ETF portfolio. Now, on the last slide, I have the competitive performance of these three ETFs, and as you will see, VOO and VTI, they have almost similar performance, up about 13% this year, whereas the Invesco product, the QQQM product, is up about 11%, and that is after spectacular performance of QQQ over the past decade, and particularly last year. Make sure to check out zacks.com/promo for an interesting offer. Thanks for watching, and I'll see you next week.